Hey everyone, let's talk about accounting. So from last week, you guys should be able to do this little exercise here. Let's suppose that the owners exchange $60,000 and in return they get 6,000 shares of common stock. So assets go up, assets of the company, and owner's equity goes up. Number two, let's suppose they bought an office building by issuing a note. In other words, a note payable. They're going to pay for it later. Well, in that case, assets go up and so do liabilities. Number three, we're going to buy office furniture for $6,000. Well, office furniture might go up, cash will go down. That furniture will probably be in the equipment account. Number four, paid worker wages of $2,000. Cash will go down, of course, and our equity will go down because that is an expense. Number five, receive $7,000 for services performed. Well, our assets are going up. We're getting $7,000. Revenue also goes up. And finally, we're going to pay ourselves a dividend of $2,500. So the assets of the company are unaffected. We're just declaring the dividend. We will pay a dividend. So that creates a liability and our equity goes down. Once you get good enough at this, it's easy enough. We're now going to complicate things a bit by introducing debits and credits.
Debit cash, credit life. Debit cash, credit life. Debit cash, credit life. Debit cash.
So in accounting, this is typically the setup. Your textbook is a little different. They're really focusing on, I think, small businesses or partnerships. When you talk about corporations, which is much more common when we think about accounting, we usually think assets equal liabilities plus equity. And under equity, we have common stock and retained earnings, or RE. Now, common stock represents all the money the owners have put into the company, whereas retained earnings is, as the name implies, this is money that the corporation has earned but is not paid out as a dividend. Instead, they have retained it in the business. Anyhow, guys, if you add the two together, all the money contributed by owners plus everything the company has earned, in total, that is your equity. Now, in accounting, this part usually confuses everyone. You probably have to study it a lot, but let me try to make it simple. When you record any transaction, it is true assets must always equal liabilities plus equity. It is also true that every transaction has what's called a debit and a credit, and the total debits must equal the total credits, always. So we have what's called T accounts. Let me show you one. Alright guys, you have a T account for every single account. And the way it works is your T accounts really keep a running total of the balance in those accounts. So with cash, if I want to make cash go up, I debit it. And that means I write on the left hand side. So I would debit cash, I don't know, $100. Maybe that's my beginning balance. If I then buy some supplies for $10, I would credit cash for $10, and I would debit supplies for $10 as well. Okay, so when I buy those supplies for $10, I credit cash for 10, I debit supplies for 10. And again, these are called T accounts.
Debit cash, credit life, debit cash, credit life, debit cash, credit life.
If you want to make a liability go up, you have to credit it. If you want to make owner's equity accounts go up, you credit them. Now how about the income statement? Well, we have these other accounts. Essentially, the change in retained earnings is equal to this year's revenue minus expenses, and of course, minus any dividends you pay out. That's intuitive, right? Revenue is all the money you're bringing in, minus all those costs, minus any profit you give out to shareholders. Whatever's left is the increase in your retained earnings in the company. So let's look at these transactions one more time, taking into account debits and credits. Transaction number 1, owners give the company $60,000 in exchange for common stock. Debit cash, credit common stock. Let's have a look. Debit cash, that makes cash go up because cash is an asset. Common stock is equity. I credit it to make it go up. Yep, they both go up, true. Number 2, buying that office building in exchange for a note. In other words, we'll pay for it later. What liabilities go up with a credit? And assets, in particular buildings, go up with a debit. So I debit buildings, credit notes payable. That works out. Let's buy the office furniture again. Let's have a look. Debit furniture, maybe equipment, credit cash. So 2 things are always true. With every transaction, assets equal liabilities plus equity, and debits equal credits. Let's pay those worker wages. Credit cash because cash is going down. Debit wages expense. And if you look up here, expenses go up on debit. So that makes sense as well. And finally, we're getting paid $7,000 for work we did. Debit that cash, credit that revenue. Now, if you follow along in your textbook, again, it's a very unusual textbook. I've been in the accounting game half my life. I've never seen this before. They like to use, instead of retained earnings, they use capital. For example, Chris Clark capital account. That is all the money he has contributed to the business. And Chris Clark drawing. That is all the money that he has taken out of the business. So in other words, dividends to himself. They kind of add these 2 accounts together, and that would be their retained earnings. Now, I would probably always refer to it as retained earnings